Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question.
Should I diversify my policies between whole life, IUL, and VUL? Okay, so there's certain things I can say and certain things I cannot say. And when I'm advising people on life insurance, and just this being just going out to a general audience, I have no idea. I can't speak for the general audience. This is a question that was directed towards a specific person, but I can say in general, I can speak for myself. In my opinion, if it were me, I wouldn't, and I don't. And here's the thing with permanent life insurance. So all permanent life insurance policies are essentially built the same basic way. So premiums go in, policy expenses come out, and then interest credits are applied to the remainder of whatever's left over. So the thing that differs between different policy types is two things really: the expenses and then how interest credits are generated. The safest one that you're going to see is going to be in whole life. The riskiest one is going to be variable universal life or variable life. And like theoretically, I guess the middle ground would be indexed universal life. And I'll tell you, in my, I don't know if you call it this, that my heretical way of thinking, life insurance is a conservative asset. It's not something that you take risk with, or a lot of risk with anyway. And if you want to use your policy, just participating whole life, dividend paying whole life, insurance has a structural advantage over other policy types. So, for example, when you borrow against a whole life policy, it's relatively safe. The guaranteed level premium on a whole life contract and the guaranteed growth rate pretty much ensures that you're never going to accidentally overloan the policy. Technically, I guess anything's possible, but it's for all practical purposes, that's not something that will happen. You basically have to borrow money, not repay it, wait for the loan interest to then, overloan your policy, and that would become a problem. But, in a practical sense, it's not going to happen in most cases. So, with a universal life chassis, it's a lot easier to do. It's a lot easier to overloan your policy or to have it go negative on cash value, go negative or drop to zero. If it happens, this is how it happens. And I've seen things like this happen before. I've seen this happen when people are trying to get really aggressive on policy loans. If crediting rates, if they dip down 1 year and they only have to do it 1 year, or if expenses rise, or you don't pay your premiums for one reason or another. Because in a universal life, there are no guaranteed level premiums. It's all planned premium. So you can say, I plan to make this amount, but you don't have to. And there's no guaranteed level premium that forces the policy to stay in force. That's not how they work. The UL policies, you put money into a cash value account. The insurance company deducts the cost of insurance and the policy charges from the cash value. And then whatever's left over that gets credited back with interest. And whatever is in a UL policy, as long as there's cash surrender value, then you have insurance. If there's no cash value, you don't have insurance. And there's a certain sense in which that simple logic applies to all policies, but in a UL, everything is assumption driven. The assumption is there's going to be cash value there, but there's nothing that forces the cash value to keep going up. In a whole life policy, there is. The premium and the guaranteed interest forces the cash value to continue to increase every year. So, in a whole life policy, that guaranteed premium has to be paid one way or another, either through policy values or through out-of-pocket premiums, but it has to be paid. So one of the two things is going to happen. Cash value is going to go up, or or you're just going to lose the policy just because you don't pay the premium. Back to this whole idea of taking risks. So if I want to take risks with my money, I will personally invest in stocks or stock options, or something else where I think I can make money. So some people prefer real estate with their risk on asset. Whatever your risk on asset is, what I have seen done successfully is whatever that risk on asset is, those people keep that separate from their insurance asset, and they're fine. A lot of times mixing trying to mix those two together, trying to mix in a risk on asset with a risk off asset like life insurance, you're basically creating a hybrid product that doesn't really serve the intended purpose as well as, alternatives. So me personally, I don't buy VUL. There's a lot of people in the life insurance industry that love variable universal life because it feels like you're doing something you're not supposed to, I think. You have a life insurance product, you have mutual funds and the sub-accounts. They're called sub-accounts, but it's essentially mutual funds. And you have those two things mixed together. And it feels like you're getting life insurance and an investment. And in some ways you are, right? And it's regulated like an investment and so on. You're getting tax advantages, so it feels like you're getting something really special. But you're taking risk in a product that is supposed to be a hedge against uncertainty. All insurance is built this way. Life insurance too. It's a hedge against uncertainty. When you buy into a variable product, what you're doing is you're shifting the risk back onto you, and you're saying, well, you're not getting rid of the uncertainty because the uncertainty comes back in through the sub-accounts because those are not guaranteed. You can lose your principal amount, your death benefit can go down, you can have all kinds of things going wrong with that product. In a UL, just a standard fixed UL, you can still get that, but there's less of that, but it can still happen. So there's less uncertainty, but there's still uncertainty. And in a whole life product, there's no uncertainty. All of the uncertainty is removed. Term insurance works the same way. You remove uncertainty with term insurance. The guaranteed products, you remove uncertainty from the table. All right, next question is, when would you consider an annuity? So annuities are great for when you want to guarantee yourself an income, but you don't want to bother with managing the underlying investments yourself, or you don't know how to do that. So annuities replace your need to worry about manually withdrawing the right amount of money every year for decades or more. And basically you're basically saying you're getting rid of uncertainty. You're uncertain about future income. The annuity takes that uncertainty and transforms it into a guaranteed outcome or a known outcome, a certain outcome. Now, again, you've got fixed annuities, you've got variable annuities. Variable annuities don't take the uncertainty out of the equation. So they don't this is my opinion. They fundamentally break the whole reason that insurance exists. It doesn't fit the purpose of the insurance policy. It tries to be a pseudo investment. So and this is an underappreciated risk. The older you get, the less time you have to recover from investing mistakes. And that includes investing mistakes in variable products because they still have risk. So one really bad move can essentially destroy you financially forever, right? And so if you get a fixed annuity, it shifts this risk back onto the life insurance company. They take the risk and they ensure that you get your monthly or annual income on a guaranteed basis. An obvious use case for this is if you're retiring. Right? And a less obvious use case for this is if you're not retiring, but you want a basic level of income, like a just in case type of thing. Almost like I hate to use this word, universal basic income, but it's kind of like that, but private and backed by actual, guarantees. Like plus it's money that you have saved up yourself. You've given to the insurance company. They're managing it for you, but they're providing the guarantees. They're hedging against downside risk. And they're doing the hedging that you either don't know how to do or can't afford to do. In most cases, can't afford to do. In a lot of cases, don't know how to do and also can't afford to do it, even if you did know how to do it. Okay, next question is, how do I get a better sense of what my insurance company is doing with my money? Great question. And I won't name the person who named this, but this is a great question. So thank you for submitting this one. It depends on how involved you want to get with this. Okay, so you have to dig into the company's financial statements. All of the investments that your insurance company makes is on the various schedules that they publish in their financial statements. Schedule A through E, if you want to look at specifics on their financial statements. So you can comb through literally every investment they make, line by line. You can also view consolidated statements. They're going to show you generally how the insurance company makes its money. So most insurance companies allocate 70%, 80%, some 60%. So somewhere between that 60 and 80% of their general account assets are going to go to safer investments like investment grade bonds, cash equivalents, stuff that could be liquidated fairly quickly. And then there's going to be some higher risk investments. So the balance of that goes into not all high risk, but higher risk that pull up the overall return of the general account. So this gives the insurance company the ability to make a decent return, lower the overall investment risk, and then also provide liquidity to policyholders when they need it. This is something that is really, people do not appreciate the technical skill that's involved in this. There is not an individual, unless you're making billions of dollars. When I say billions, I mean at least $5 billion in assets. If you're not operating at that level, there's no way that you can replicate what the insurance company is doing, because they have access at that level. Insurance company, and I'd say this for even smaller insurance companies. This is one reason why I generally stay away from smaller insurance companies, because if you get to let's say somewhere, it's in the neighborhood of $5 billion. If you're operating at a lower asset portfolio value than that, you simply don't have enough assets to do the kind of diversification that you would need to do. But also, you don't have access. You can't attract the type of you don't have enough money to attract the type of investments and sellers that give you an edge on investment return, but also special products that you can buy at that when you have that kind of money to throw around, that give you an advantage when you're trying to do those hedges. So, that basically excludes like 99.99% of the population, right? Maybe Warren Buffett could do this if that's what he really wanted to do, right? Is turn it himself into a more conservative insurance company. But really, like, most people can't do that. They don't have the money, they don't have the money to do it. And also then you need to have enough skill to do that too. It takes some technical skill to do that. So anyway, that's kind of how you would look into what your insurance company is doing with the money. Anyway, I hope that helps, and thanks for sending me these questions. I enjoy reading them. I enjoy answering them, and I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.